From the 1st to the 14th of June 2019, we saw 69 funds witnessing a drop in their NAV. Over 25 of them had their NAVs drop by more than 7%, which is a return that we expect on our investments in debt funds over a period of 1 year. Does that make debt funds an unviable investment option? In my opinion, no. What we have to do, and in this video we'll explain to you how to do it, is how to select the right debt fund so that you can minimize the chances of a loss of NAV due to a downgrade of a paper that happened during the first week of June. Welcome to Kelp Decoding Investments. My name is Arpit Agarwal. It's our YouTube channel which you can subscribe, you can like this video. You can also download our app Kelp Decoding Investments from the App Store and Play Store, where you will find all of our videos in one place organized as courses. In this table, we'll take a deeper look in the funds which witnessed a drop in their NAV, in which categories were they funds belonging to. There were a total of 308 open-ended funds that we have taken for our study, and 239 of them witnessed zero drop in their NAVs. In fact, their NAVs went up. Only 69 schemes had a drop in their NAVs. The funds have been arranged from left to right on the basis of their average duration, which in a separate video we will explain in greater detail. The fund on the extreme left is the overnight fund, which has a duration of just 1 day. Liquid funds have a duration of a maximum of 91 days, and the extreme right long-term debt fund has a duration of paper which is more than 7 years. So, taking the example of a money market fund, there were 16 of them that gave positive returns. Just one money market fund was carrying a commercial paper of DHFL, which it had to write down due to the downgrade, because of which it witnessed a fall in NAV of just about 2%. Now, why does this happen? This happens because of the various categories of paper that these mutual funds invest in. So let's look at how the AUMs of these respective categories are divided across securities asset classes. And what we see here is that cash and cash equivalent, which has the lowest credit and lowest interest rate risk because it has a maturity of just 1 day, is maximum in the overnight fund. 100% of the AUM of an overnight fund gets invested in cash and cash equivalents, and that's why we've colored it green. The next category, which carries a slightly higher risk compared to cash and cash equivalent, is money market, and we've also colored that green, but a lighter shade of green, and you'll see liquid funds and money market funds have a large portion of that category. Moving on to the next category, which we've covered blue, is called the sovereign debt, which is paper issued by central and state governments. Now, these paper carry virtually no credit risk because their borrowers are the government. So if you are an investor who needs to be safe and who does not want to take, credit risk, then it is advisable for you to be with funds which have a larger portion of greens and blues. Now we come to the next categories, which is corporate debt, which was, as we saw in the case of DHFL, corporate debt, and their debt was rated AAA, which is the highest grade, and that we've colored yellow. Yellow only means is exercise some caution while you're looking at these funds, because events like DHFL can happen to other securities also. What it also means is that the funds which had DHFL are not bad funds. It is just that they had a paper which got downgraded, and therefore by the regulation they had to revalue the paper that they were carrying. It is possible tomorrow another paper of another company may get devalued or re-rated, and the AMCs or the funds which are carrying that paper will face the same fate as the AMCs or the funds which were carrying the DHFL paper. The last category, which is the highest risk, is sub AAA and unrated, and you would see a large portion of funds also carry that paper. Now, the intent of carrying that paper is to give a higher return to the investor by taking a little more risk. And that is the nature of debt market investing. So now let's look at what kind of returns has each category of these funds given over the last 5 years. And what we see is that the 5 years annualized returns from overnight ranges from 6.71% per annum to long duration funds at 9.5% per annum. So it's very evident that the lower risk you take, the lesser returns you get. Now, how does it apply to our investments? If you are an investor whose money is lying in savings account, and in my 26 years of investment history, I have seen thousands and thousands of investors who just keep their money lying in savings accounts. And savings accounts are getting you an average of 4%. So if overnight funds, which carry virtually no risk, have given you a return of about 6.7% over a period of 5 years, it would make sense to shift some of that money into overnight funds because they pay you back in one day. You can put in a redemption before the cutoff time on today, and tomorrow you will get your money. If it's on a Friday, you'll get your money on a Monday. So mutual funds are not bad. It is our choice which causes these potential losses, because before investing our hard-earned money, we have not spent the time to delve deeper and explore and introspect and study and research to see, if I'm putting my money in this fund, what is the risk that I carry by investing. Most investors usually just look at returns and say, if this has given a return of so much, then I will invest in something which has a higher return. And they tend to ignore risk. We hope that this table will help you, and you can take a screenshot of this, save it in your mobile, and the next time you want to buy a fund, or if you're an advisor and if you want to recommend a fund, you can show this table to the investor, or you can see this table, refer to it, and assess where are you putting your money and what kind of risk do you carry. This is the AUM distribution of the 11,72,000 crores of AUM that existed on 31st of May 2019 across these funds that we have considered for our study. And you would notice that 47% of that AUM sits in liquid funds. And over 65-70% of that AUM sits towards the shorter end of the spectrum, which means on an overall basis, the investor community in debt funds is largely risk averse. So therefore, if you're a retail investor who's starting off in mutual funds, or a retail investor who doesn't want to take too much of risk, my recommendation is stay towards the greens and maximum a little blues. And if you are an institutional investor, a seasoned investor, a high net worth investor who understands the nuances of credit risk, duration, defaults, maturities, then you should start looking at funds which have the yellows and the reds. So let these colors be your guiding principles, and we hope they help you safeguard your hard-earned money. Keep watching our videos. You can write to us for anything additional that you want us to bring to you on help@kelpmail.com. You can write to me directly at Coach Arpit on Facebook and Twitter, and I'll see you next time.